So Tiamo requested that we look at this paper, last year's paper. So we'll quickly look at question 1, then we'll go to question 2. Hopefully we'll also go to question 3 today, since it's the last day. The question reads, you purchase a single bond note, which has a face value of 20 million and a coupon rate of 7.5%. The bond matures in 10 years and the rate of inflation is expected to be 4.5% per year over this period. Your minimum acceptable rate of return is 7%, and use this value as the discount rate. Answer the following questions. Please complete your calculations on the Excel template as provided, so you'll be given the template. Draw the timeline showing the nominal cash flows over the 10 years. Calculate the inflation index for each year over the period. Start with 1.0 at year 0. Then calculate the real cash flows for each year and show these on the timeline. Calculate the NPV of all nominal cash flows using MA. Calculate the MA in real terms and adjust it for inflation. Now calculate the NPV of all the real cash flows using the answer for E. Finally, calculate the internal rate of return for the real cash flows and check your answer using the formula for inflation. So first, we need to understand the theory behind these numbers so that it becomes easier for us to model. You cannot model what you don't know. We know for sure that the bonds are risk-free, that we know. And mostly these are government bonds. You'll find maybe the government of South Africa or government of Zambia, they are broke. And they cannot go out there to source for financing. So they'll start selling papers, which they'll call as government bonds. So Sholo will go and buy bonds from Mr. Ramaphosa. And Mr. Ramaphosa will give Sholo a plain paper or just a blank paper. Maybe just written that you have bought a bond. It's more virtual. But then, what Sholo is comforted with is that she'll be getting coupons every year. Coupons it's basically the interest income that you generate from your investment. So a bond becomes an investment. And your bond will be near 0 because it's now, you're just going to cash in or to give the money to Mr. Ramaphosa so that he can construct or maintain roads in South Africa. Then Mr. Ramaphosa tells you, if you give me money, I'll give you this paper. But what this paper will do is that every year end, you'll be receiving a coupon of maybe 7.5%, like in this case. But at the year of redemption, you will not only get your coupon, you will also get your investment in full. So if it is 10 years, we expect in the 10th year, this 20 million will actually be part of the investment. There are two confusing things that most people get confused of. Real and nominal. Economists like these terms. And sometimes they also use them interchangeably, not knowing that they've made errors, but no one would actually spot those errors because they speak very fast. They're like bankers. Bankers speak very fast. So when on real rate is that it has been adjusted, or inflation has been adjusted in the real rate. So there's an inflation adjustment in your real rate. It assumes that you do not have any inflation also. So you have adjusted that and you have a real rate. Nominal rate is basically the value of money. That is what you have. So if you have 150 here, it will be 150. But then the $150 or rands that you have, what's the real rate? Then you start now factoring in, adjusting inflation and all that. And we've been given a very good formula, which is 1 plus nominal rate divided by 1 plus inflation rate minus 1. It takes us to real rate. But ideally, it doesn't matter which route you use, whether you're going for real or you're going for nominal. We expect that when we compute the NPV, that NPV must always be the same. Doesn't matter the route that you're going to use. Now that I've done a preamble, we can go to Excel and start computing these. So we can put the assumptions. So the first value, 20 million. 20 million rands.
I think it's 20,000.
20,000.
Oh, 20,000. Oh, okay. You can see that I'm in a hurry to become a millionaire. Yeah?
It's coming, it's coming.
Yeah. Coupon rate, 7.5%. The period, maturity period or debt, will be 10 years. What else? Inflation rate. $4.5. Your minimum acceptable rate. If you have seen the way I'm doing like this, all you do, and these are small techniques, because you are going to be given your PDF. I'm sure that PDF obviously will also be electronic. That is if it will be electronic. You also have Excel, which will be electronic. So you just press Alt tab like this. Okay, what else? The MA, which will be the discount rate. The minimum acceptable rate.
What are you pressing, Patrick?
It's out, then you press tab, which takes you to the sheet that you, so I do like this, takes me there. I do like that, it takes me. Yeah, so you press out, then you hold out, then you start pressing the tab. It will be shifting, switching from one window to another, yeah. That is if you are going to have this document in PDF.
Yes.
Mhm. Okay, so let's first ignore what they have said in there and just complete this thing. Mhm. So here we can also try to find the real rate. Mhm. Okay, so we are saying if we use should be the Fisher formula, where we are saying finding the real rate equals to 1 plus nominal rate divided by 1 plus inflation, close bracket, minus 1. Mhm. Okay. So in this case, we know the one that we're calling MA is basically the nominal rate that we'll use. So say equals 1 plus 7% divided by open bracket 1 plus inflation minus 1.
Why are we using MAR, not coupon rate as a nominal?
Huh?
Why are we not using a coupon rate as a nominal?
No. Sure. Coupon rate, remember that is the actual money that you're getting. It's not a discount. It's not a discounted thing. So for the coupon rate, we are going to use it to know how much coupons will be generating or be accruing to the investor.
That's the only place you're using coupon rate.
Yes. But then eventually you need to do the discounting. So these are the numbers you have to use for discounting. This MA is basically a proxy of nominal rate. Yeah. And because we have been told by the examiner, just check it here. We have been told by the examiner, your minimum acceptable rate of return is 7%. Use this value as the discount rate. You get it?
Yeah.
Mm-hmm. Always reserve the coupon rate to just computing the coupons, for computing the coupons. That's it.
Okay.
Mm-hmm. Okay. Mm-hmm. So this rate we have adjusted inflation. Mm-hmm. So we'll start from 0. So here we have 1 because that's 1. Mm-hmm. You shouldn't worry much. You have a template. I'm sure they have already done the template already, but it's better sometimes and just check how these things work. Okay. Mm-hmm. So the first thing that we need to do is also to check to see how inflation progresses. So we can call it inflation index. So on inflation index, in year 0, there's no inflation. It is at 100, which is basically 1. Then at the end of the year, inflation will grow by 4.5%, and it will continue growing by 4.5% as we move on. So meaning that we are going to have this 100% times open bracket 1 plus 4.5 inflation. Please lock this cell by having two two $signs, a $sign before the column, before the column, yes, meaning that you're locking the column so that it shouldn't move. Again, another $sign after the column, it means that you're locking the row. So you just put two $signs before and after. If your laptop is okay, you can use your F4 key as a shortcut, or F4 key. If it doesn't work, you use Shift F4 key. So all we are saying here is that inflation will be growing by 4.5% year on year. So take this up there. So it shows that by the 10th year, inflation would have grown by 55.3%. Hello, I can't hear you. So we have the inflation index. Then now let's look at the investment plus the coupons. So I can call this, I'll call this as cash flows. So in the first year, the investor, you as the investor, Sholo, you invested, you bought bonds worth 20,000 rands. From Mr. Ramaphosa's government. Chiamo, just mute yourself. I'm getting some feedback. Thank you. Then, President Ramaphosa promised you that if you give us a $20,000 or 20,000 rands to maintain the roads in Alexander, we promise that we'll be giving you interest of 7.5% on your investment every year. You can decide whether you'll be getting it in November or in December, but what you should be assured is that we'll be giving you, Shoro, 7.5% of the money that you invested because you're patriotic. So this has to also be calculated. It will be the 20,000 face value that we have there times the coupon rate, which is 1,500. So we are promised that we will be receiving this 1,500. I'll go up to the 10th. In the 10th year, because you are redeeming, this investment will be redeemed in the 10th year. So I'll not only walk away with a 1,500 rands because I'm no longer interested in buying any bonds. I'll even be given what I initially invested. So in this case, you have a windfall of cash. You can even go to Limpopo and buy cattle. I come from a region where we are headsmen or head boys. We believe in cattle so much. So I hope you do, Shoro. Then you'll go and buy some few goats or heifers in the 10th year. So this is what you have. Basically, when you look at this, this is basically the value of money. Oh, sorry. In short, this cash flow is nominal. Now you need to do some adjustments so that you take it to real. So you are going to have cash flows. Real cash flows. So with these real cash flows, is that you are adjusting inflation. So this is what is going to happen, is that you're going to have your nominal values. Again, I can do this. Your real cash equals to nominal values divided by 1 plus inflation. It's the same thing. So the real values, we are still using this formula. The real values will be this 20 divided by your inflation index. So it's 1 plus inflation. This is why I've put the inflation index on top there, which gives you that. So we know that the real cash is down there. Okay, now that we have the cash flow nominal and we have real, we can, if we are to come up with, hello? Okay. So we have these numbers. So the next thing now that we should actually do is to find the net present value for both. So I'll say NPV nominal, NPV real. If what we have done is correct, there shouldn't be a difference between the NPV nominal and NPV real. So say equals, remember what you do at first when you're calculating your NPV using that NPV formula is different. I think I'll also show you, I've done that before anyway with you guys, where you just bring in the discount factors down and use them to discount. We are going to do that. Maybe let me do this first. Okay, let's start with this method 1. So say you pick your investment. Let me just pick this. Plus NPV tab. This is your NPV function. They want you to get the rate. You have the rate, which is this one, the 7%, the annual rate, comma. Then you pick the values from year 1 up to year 10. Press enter. Then now we go to real. So like I said, there shouldn't be any difference between real and nominal if what you have done, RICO, is correct. So we'll come there. Again, we'll pick the initial investment. Initial investment, it is not ideally not supposed to be included in the NPV function, the Excel NPV function, because that NPV function, there is a rate there. So it assumes that in year 1, you are going to discount. So this is why we isolate it, because we know for sure that in year 0, the value of the capital injection will be equal to what you have invested in there, because it is now. And we're doing all these things so that we can make a decision. So there I will say plus NPV again. The rate, now we pick the real, which is this 2.4, comma, we pick the values up there. Mhm. So this is how you do it. But let's, in case you will get a bit confused on the NPV and using the NPV function and how you include the initial capex, we can still calculate using the discount values. So this is what we can do. Here we'll have the discount factor, and there we'll have a discount factor. And here we're going to have the present value. And here we're going to have the present value. So the discount factor, always you say equals 1 divided by, open bracket, 1 plus, you pick for the nominal, which is the MA. You lock that by having $2 signs. Close the bracket, to the power. You pick the periods. In this case, it's period 0, so we expect that we are going to get 1, just 1. So you do that. I know you used 2 percentages. I'll put the percentages like this. Then you highlight up to a 10, Control R. You can then now put. So in terms of the present value, you multiply 20,000 times the discount factor there and take it up to this side and close. You do the same thing here. Under the discount factor, we'll say equals 1 divided by, open bracket, 1 plus the discount factor, the real rate, which is 2.4, close, to the power, you pick the period, which is year 0, you'll get that. You take it up to there. And get the present value. Do the same thing, 20 times 100. So once you have these numbers, you can calculate your NPV, which is for your nominal. You say sum, you pick the present values, you sum all the present values, you have that number. It's nominal, NPV, we go for real. Again, you do the same thing, which is sum, and you pick that. Terence, is it okay?
Yes, sir, it's okay.
So you have been requested to compute your internal rate of return, IRR. You know, IRR is just a break-even point where it's basically a point at which your NPV will be 0. Sorry. So for the nominal, you can do this, you can say IRR, then pick the cash flows under nominal, which is these numbers here up to there, enter, get a percentage. So for the real rate, suppose I do this and just check. I use this one on nominal, if I use the nominal down there, what am I going to get? And just give it a try. 1 plus that divided by 1 plus inflation minus 1. That's right. 2.87. If I use the IRR type in getting the real rate, it should give me the same answer, I think. And it's otherwise. So say IRR, I pick the values from here. Very good. Any questions? I'll go to the real things. I'll go to question 2.
All clear.
Rico, I can't get you.
I'm saying I'm following. I'm following.
So these questions, it should be just some theories where you have to write 1 or 2 things, but otherwise, I'm not seeing why you should have the whole 3 hours for these papers.
I want to ask, why is there a difference between the real rate that you just calculated now and then the one above?
It's because we used the IRR, the IRR nominal of 7.5. We have worked backwards. But that was the first.
Okay.
So, okay.
No, it makes sense.
Yeah. This one, you can see the variables that we have used. We have used different variables in here.
Yes, yes.
Okay, let's go to the most serious things. Let's go to question 2. So here you write your theories and whatever, but ideally this is what is required. So, okay, let's move on. Question 2. Where do we start from? Obviously, there's an article up there. In this question, you are going to check the author's calculations for IRR and then PV by applying the spreadsheet model for T large company work. We use this spreadsheet in the tutorial. T is Techno-Economic assessment, blah, blah, blah. So you have used this same thing. You know it much better. Open the spreadsheet copy, the right tab to your answer worksheet and enter the following information into the input cells. Plant capacity, unit size per panel. So I'll just pick this, copy, instead of typing. But I know from your template, you have these numbers. You have these unit size per panel. Capacity factor, unit selling price. Copy that. Capital cost. What else? Quite a number. Fixed cost. Labor cost. Raw material cost. R&D cost. Super panel work. Have the tax rate. We have inflation rate. Oh, inflation is at 0. Okay. I've left it out. Depreciation period. And project life. Okay. So first we have to understand the question nicely. So we are told, we are told that the plant capacity is 1 gigawatt. And we have the unit size per panel, because like they are selling per panel, which is 310 watts. So let's first understand this thing nicely. Otherwise we'll not get it right. So for me, okay, everything's per panel, per panel, per panel. Okay. I'll convert this to watts. So the plant capacity, if we have 1 gigawatt, taking it to megawatts, or taking it to megawatts to be 1,000 megawatts. Then from watts to, what's the conversion? Watts to mega? It's 1,000, isn't it? Am I confusing myself? How many? Okay, here, if you have 1 gigawatt, taking it to megawatts, it will be
1,000. 1,000 megawatts.
Yeah, but taking to watts.
Oh.
We have to simplify this question.
It will be 9 zeros.
Yeah.
It's 9 billion.
Oh, it's 9 billion?
Yeah. Sorry, 1 billion. Sorry, 1 billion. Why am I saying 9? 1 billion.
Oh, okay. So okay, let me just get it right. First, if we leave it like this, this is the megawatts.
Yes.
Then if
multiply by a million.
Okay, by million, like this.
Yes.
Yeah, that's
clear. Then the units we have, we have 310. This is per panel, which is that. Then we are told that the capacity factor is 80%. Here now, because they are selling per panel, we need to know the number of panels. This is how I would interpret it. So the number of panels So the number of panels would be that 1 million divided by 30 by 310. Then we have 3.2 as number of panels. But then we are told that the capacity factor is 80%. If I want, I can leave it like this. Then I can bring in another thing that actually factors in the capacity factor. Which then you have this number of panels times 80%, because your revenues will be generated from your capacity factor, which then gives us the number of panels, including or factoring in capacity factor of 2.5 million. Is it making sense, guys?
Yes, sir.
Yes, sir.
Okay. Then the unit selling price is $44 per panel. Sorry. Per panel. The story now is becoming much easier to understand. What are we told on the selling price? That the selling price, there will be a reduction of 1% per year. Annual. Capital costs, we have been given 30 million. The fixed cost, $550. Raw material cost, 34.36 per panel. Per panel.
That's labor cost, sir.
Oh, sorry. I'm happy that you are able to see what I'm doing, Rekwan. So labor cost, it is 1.65. I'll remove that, just wanted the format. Then research and development, 4.12. Is it 4.12? Yes. Also the panel. So from here, I can do like this and say the variable cost, the total variable cost, which will be per panel, which will be equal sum, and we'll pick in this. I'll do that. I don't like these green things. That's all I'll say, ignore error. Okay. Work, which is 10%. This. %. Inflation is 0. Oh, I haven't even gone to inflation, sorry. Tax is 42.24. Is it 42 or 24? 42.4. So the moment you see tax there and see depreciation, you will know that you will need to use your depreciation to calculate the tax. Then now you can go into your cash flows nicely. Depreciation period, we have been given 10 years. And project life, 10. So I'll do like this. So as a financial modeler, I always want to have these coded because it's very difficult for one to know which ones are hard-coded and those that are formulas. So I'll press Ctrl G, then I'll go to special and say constants. I'll leave numbers and do that. Then now, then go to home. You don't need to do that in the exam. You don't need to. So I'll pick that. And we normally use this color. What is it? Okay. So that it's easier for me to know which ones have been hard-coded, which ones are formulas. So those that are in black, there are formulas in there. Those in blue are hard-coded. They are real assumptions. Okay. So I'm worried you're too quiet. What is happening? So then now,
They are the states.
So then now we look at what. So basically we check on what is required, but at least the heavy weightlifting or heavy lifting, we have done all the heavy lifting just by having those assumptions and understanding them. So it says, using the Excel template provided, answer the following questions. In the introduction to the article, a number of approaches to studies of financial feasibility are reviewed, including discounted payback time. Based on your understanding of payback period as covered in the slides, explain briefly how a discounted payback period time is calculated and why the author decided not to use the method in their study. I haven't read your document, but let me just explain something here on discounted payback period, and we don't usually use it. We use a simplistic method which looks at nominal actual money. That if you invest in this particular project or company, how long is it going to take you to recoup what has been invested, both on the debt side and on equity side? So all you're doing, you're looking at your cash flows, looking at your investment that you have, then you start accumulating it. At the point where you won't have a negative, that's a point at which you have met your full payback period. Oh, I thought I'd done something here already. Okay. Discounting payback period is highly theoretical. And this is why NPV as a concept is very difficult for non-finance people to understand. Why do you have to discount the 150 that you're going to get at the end of 10 years? And you say that money is equivalent to 2 rands today. Non-finance people not understand that. But the payback period, they understand it because you are dealing with actual cash flows. But over time, others have decided to come up with a discounted payback period, though it's still not common. I usually don't use it in my modeling. I know you write your own things you have read on a discounted payback period, but I thought there was need for me to explain it. The problem with this discounted payback period, it's like you are just coming up with your net present value. Basically, that is what you're doing. So if you get a negative payback period, a negative NPV, then it means that even your payback period will be negative. And most of the stakeholders will not even understand what this discounted payback period is because it doesn't make sense. Okay. I just wanted to give my views on this. B, calculate the total annual output of solar panels at 100% capacity. Repeat this calculation for 80 capacity and use the latter value for your T. So what we did there, so what we did here, it was basically panels. So if we want to know the output at 100%, the output at 100%, it means that we are going to have this divided by, let me not get confused. That times 24 hours times 365. Then I want to take it back because I'm getting confused on the watts. Let me just put those 9 zeros. I'm not used to watts. This one gives us 8,760. Then from there, this is energy that I'm following. I would say from first I took it to gig. I'll multiply by 1,000, taking it to megawatts. I'll multiply by 1,000, taking it to kilo. Which gives me because it's basically times 1 million, which gives me that number. But then this is at 100%, and I'm comforted that I'm not going to use these numbers in computing revenue because I'm told the revenue they are computing it per panel. So I'll come here and show energy. At 80% at capacity factor, which will be this times the capacity factor there. So gives me these numbers. But they look so huge. Have I confused? Should be this first. Let me do that. There's board mass, yeah? Still the same. Okay. But then my interest now is in coming up with the profits so that we compute tax. Then we're going to add back any non-cash item so that it takes us back to cash flows. You are lucky, you'll be given templates. It's just a question of plugging in the numbers. But for learning purposes, we'll have to, because I don't want to use your things, you have to see how these things are created from the scratch. So start from year 0. It's how many years? 10, eh?
Yes, that's 10.
Mhm.
Mhm.
Yeah, this is year 0. Leave it to general. Mhm. Okay. So we'll look at the sales. Then we'll look at the variable costs. Then we'll look at the fixed costs. Then we'll actually bring in depreciation. Mhm. So on the cost, we have been told on sales, sorry, remember that sales will be reducing, sales is going to be reducing by 1% on an annual basis.
Yes.
So if we want, we can just include a line on top. Do this. Mhm. Just somewhere here. So I'll call it degradation rate. That's what I'll call it. Mhm. Okay. So in the first year, obviously you're going to have it at 0%, or should I say 100%? Mhm. In year 2, it will be this times 1 minus, where's the 1%? That. We shall take up to year 10. Okay. I don't know if it's correct here, or it should be, if it's 1%, meaning you're going to have 100, 99, 98, 97, right? Not what I've done. Maybe it will be, it's not a growth. It will be this minus. It's not on growth, minus that. Okay. I think now it makes sense. So on sales, we are saying we have 2,500, the panels there that are active, times the rate, which is 44, somewhere up there, 44 per panel, log, times the rate, which is 100% there. And I'll take these numbers up to there. Okay. So we have the sales, then we go to variable cost. Variable cost. Pick the same number here. Times 40.13 per panel. Have these numbers. I'll take it. Oh, should be negative, sorry. Let me just put a negative. Mhm.
How do you do that?
Yes, Shoro.
Yeah, you see this brackets, this negative brackets. I
This-
still get confused with them.
Oh, as accountants, we put those brackets, representing a negative. Mhm.
But you put the negative there. I see it's negative there, but
Yeah?
on your cash flow, it comes as brackets. I think that's what's messing up.
On the cash flow.
Right.
Mhm.
Yeah.
Mhm.
I'm saying, how do you do that? As you're saying, accountants, because at the top there on the formula, I see it's a negative. But how do you reflect it as brackets instead of the real negative showing throughout?
Why we show it as negative in here is basically to say it's an expense, so it becomes easier to start in summing the numbers. If we wanted, we could leave them as the positives, but some people may get confused, may think it's a cash inflow. So whenever we put those negatives, what we are saying that those numbers are cash outflows. Oh, you wanted to help Rico? Is it
No,
good?
First Break. Yes, First Break. I'm saying, I think what Jolo is saying is that, see there on that FX tab bar there on top on the equation, it's written as negative. So if you click on the number itself, like you can go to the number,
Mhm.
go to the negative number.
Mhm.
Yeah, you can click it. You can see there on the F at X is equal to negative $D. It's negative there, but on the actual flow here, there's a bracket instead of that negative. I don't know if you're following that.
There are these brackets.
Yes, so there on the equation panel there on top, it's a minus, but on the reflection of that minus here is a bracket.
Yes. So this is what I was saying, Rico, that accountants, we like putting negatives. We like putting brackets to represent negatives. It's just a format. So if I come in here, if I want to change this format, I'll pick this one.
It's a format.
Yeah, I'll do like this. Just wait. I can even change it from here. I can do this. Just wait. I'll say this negative hash, comma, hash, 0. Of something like that. Sorry, I can pick something like this. I can have something like that. But look how ugly it looks.
Yeah.
As accountants, we don't do that.
Okay, no.
So rather we format them like this. Then we go to the fixed cost. What have we been told on the fixed cost? Okay, we have that number. I'll lock it, put a minus there. Then on depreciation, we have been given on depreciation, we have been given that the project life or the depreciation period is for 10 years. We can easily divide the 30 million divided by 10, so we know the depreciation, that is 3 million. But sometimes if you want to impress your lecturer, you can put in a function, but it doesn't matter on this one. All I can do, I can say equals if this number here is greater than the depreciation period, which I'm going to log. You don't need to do that. I know in your documents, I'm sure they would have put that. If it is that, then if this number down here is greater than that number, give me 0. Otherwise, give me the depreciation. SLN, this is the depreciation formula or straight line, but you don't need to use this. You You may make a mistake. You may overimpress your lecturer or marker, then you will get annoyed. So solve the 0 is 0. There's no solve the 0. Then the life.
Which one is the simplest method?
So you do that, which is you put your negative this side. You don't need to overimpress him, and I'll show you what you can do. But if you want to put a formula, this is what you would do. But in this case, I would rather I come here and calculate my depreciation because it's straight line, so it doesn't change. So I'll come in here and say equals 30 divided by depreciation period of 10, giving me 30,000. So I'll not complicate my work because I don't need to make a mistake to start over impressing him. So I'll say equals minus 30,000, 3,000. Then I press Control and press Enter so that it gives me all the numbers up to the end. These are just shortcuts that we use. Okay. So now we can get the profit before interest and tax, which is PBIT. Then I would add like this, giving me this number. So remember what we were doing last time we met. Is it yesterday or what? Or the day before? Where after I get this, our aim is to find the cash flows. That is what we want to do. So if it is the cash flows that we want, then we'll have to add back. Oh, sorry, before we add back, we need to find taxation. This is why we're doing this. Sorry. So taxation. Taxation, we have been told about the percentage tax rate of 42.4%. So say equals, then here again, you need to be very careful. You need to be very careful because where there are losses, meaning you are not supposed to pay tax, isn't it? You are not supposed to pay income tax. So this is what you're going to do. You only pick the maximum. So say equals max, open bracket, pick profit before interest and tax, comma 0, then times. So you're saying if it finds a negative, it should give you 0 as a minimum value that you want, times the tax rate of 42.4%, which you're going to log, and press enter. So you'll see, when I take this up to the 10th year, where there are negatives, I'll get 0, 0, 0, 0, because I cannot pay the government tax if I did not make money. So now that we have the tax part, we can then now, find profit after tax, which I'm going to call as net profit if I wanted. Okay, this is the stages how you move in a very methodical way. So we'll have the sum, we need to sum this, which is the profit before tax. Actually, we'll do this. It's this minus tax. If I wanted tax as well, it's better I leave it in negative so that I don't confuse myself. So I'll come here and say equals sum. We pick these two, enter. for R.
I think you didn't add up the depreciation back.
Eh?
Or
No,
I'm
we
being too
haven't.
forward.
Yeah, very, very ahead of us. Yeah, very ahead of us. And congrats for that. So
I thought you add it before you do the
Ah,
net profit.
no. You don't add it because here, obviously, while you're doing your depreciation, you wanted to calculate tax. Now that we have tax, we have the net profit, then now this is when we say add depreciation.
Oh,
So that we go now to the cash flows. Mhm. So here on depreciation, I'll say because it was a negative, I say equals minus, I'll pick it as a positive like that. Interesting. Mhm. Okay. You guys will not be doing these things because in your, obviously your templates, he has already put in formulas and all that. I assume that he has done that.
but then those formulas are tricky compared to this. So
So then now we go to our cash flows. At this level, the cash flows would be equals sum that these two have these numbers like this. Okay. Interesting. Then now we can bring in the investment. What was the initial, the capital cost? Which would be in year 0 equals minus, we pick the 30 million. Or not this one, it's on top. What's the 30 million? Okay, it's here. So I will do that. So I can call it as a free cash flow, FCF. So will be this, these two numbers. Now, we can bring in the discount factors. What was the discount factor? Well, we given the discount factor. In this case, we have the work of 10%. You know what to do on the discount factors, guys. You start with, say, equals 1 plus discount factor of 10, our log, to the power, I'll pick the period, which is 0 there. You like having them in percentages. And I'll take it up to there. So, hello? So the present values would be that times this. For me, I wouldn't even want to do the discount factors and all that because I have the NPV function in Excel can easily do all these things. But depending on how your template is structured, and I guess it's structured like this, so I'll have to do this. So if we're getting the NPV, this is what I will do, just say equals sum. I'll pick these numbers, enter. Then the internal rate of return, let's say equals IRR, and I'll pick from the free cash flows there. Something like this. Okay, so let's check on the question. I'm saying calculate the annual revenue without end revenue adjustments. So you can do that without adjusting the minus whatever. Prepare the annual revenue calculation, but this time assume that the price will decrease by 1% per year. The price adjustment, the price at the end of year 2 will be 99%. This is what we have done. This is what we factored in there. So the first one, obviously, they expected that you're going to have at 100. So if it is at 100%, meaning that this only selling price decrease, it would have been like this. And it would have given you your NPV, which is positive, and the internal rate of return of 18.14. That was the first scenario. The second scenario, they wanted you to factor in the selling price decrease, and you're going to have a negative NPV and a very small internal rate of return. And this is a problem. If your internal rate of return is lower than the cost of capital, it means that you're not creating wealth for your shareholders, because the work is at the cost of money is 10%, yet your returns, because internal rate of return, basically it is your return. Your return it is at 3.78%. And this is the reason why you're having a negative NPV. But if you had a positive here, you expect the internal rate of return to be higher than the cost of capital. Rick, are you getting me? Rico?
Yes, sir. Yes, sir. Makes sense.
I'm the one who's lost here.
Okay, so what I'm saying
Yeah.
is that remember always, whenever you're comparing, when you're doing your analysis, always compare your work against your internal rate of return.
So in order to be making profit, you're supposed to get anything greater than 10.
Yes, anything greater than 10. So your internal rate of return is lower than your cost of capital. For example, this what it means is that when you go and borrow 100 rands from FNB, you invest in this project. The cost of borrowing this money would be that 10%, which is 10 rands. But your returns, this will be your cost. From this particular project, your returns is that 100 that you have times 3.78. So you have lost 10 kwacha, you have only gained 3.7. Your net loss, what it means is that your net loss in this investment is 10 minus 3.78.
Okay.
That is what it means. So why did you even bother yourself to go and borrow 100 rands, invest in this particular project? You're only able to generate a return of 3.78. Yet you're paying FNB on interest and the like of 10 kwacha or 10 rand, sorry. So it is very, very dangerous. Your return, remember that this is always your return. So whenever you're doing an analysis, compare it with your work. If your return is higher than your work, it's automatic that your NPV would actually be positive. So in short, what should have actually happened here, you shouldn't have even borrowed at 10%. The cost of money shouldn't have been at 10%, should have been at about 3.78, and I'll show you. If you had negotiated well at 3.78, check what is going to happen. You have a 0 NPV there. If I put this number, which is 3.78, I come down here, you see you have a 0 NPV.
Looking even.
This is why we always say your internal rate of return is your break-even point. And it is advisable that your break-even point, your internal rate of return, must always be higher than the cost of money. So this is how your project is. Any questions? You okay now, Tiamo?
Yeah, I'm okay. Can you just go into your NPV formula? Just want to see how you got that.
I use the PVs.
Okay, use the
Yeah.
PVs.
But if I wanted, like I was saying, depending on how your template is structured, if it's not mandatory that you should do your PVs like that, I wouldn't waste time. All I would do would be this.
NPV formula.
I would come in there, yes, and pick the capital cost. Where is it? This is free cash. Pick this. Plus, then NPV. Do that. Then pick the rate, which is the what? 10%, comma. Pick the values, the free cash flows. Pick these values and close and enter. That's it. I wasn't going to bother myself doing all these things here.
Okay.
Sheer waste of time.
Yeah, because now you have to discount unit of the discount factor and discount.
And you have to remember how you do
the
discounting, you know.
Yeah, you can make a mistake there too. Yeah. But it's good to know all of them because you never know how it's gonna come out in the exam.
Any questions? Is it okay? We go to another question. It's just basically the fundamentals, guys, that you need to learn. You need to
quick on me, Fitzpatrick. So I just want to know here. So in answering these questions, I see that we just answer them stepwise, you know, because but on the question paper it comes with A, B, C, D, E, F, G. Like,
so what you do?
Everything here,
so what
it's like intrusive.
Yeah, but what you do, you start getting from there. All you do, you say B. After I've done this, you say, if you're starting with, which one first? You're starting with A. Don't leave it like that. You're starting with A. So you say solutions.
Okay.
You start with A. A, they're asking you only DPT. You explain what it is, those things that were explained, the theory. You explain the theory. B. What? I'm going to check YouTube. So you explain the theory, you go to B, calculate the total annual output of solar at 100%. So then remember I'd shown you at 100% what you do. So you can show year on year if that is what they want, but at 100%, so you can change that and use and do the same thing. If I were you, obviously I would say for B, I'll do this. Then I'll say I'm starting from here, which is year 1 plus 1 there. So what I would do, I'll come there and say revenue. On an annual basis, because it is not going to reduce anytime soon. Actually, I don't need to even to go up 10 years there. So what I would do, the annual revenues, if it is at 100%, I'll do that. Actually, I don't even need to do all these things. You know why? I don't need to do even all those things. I'll say, yeah, 1 to 10. So revenues on annual basis. So I'll pick what is in year 1 because it wasn't discounted. So I'll pick this number. That is what will be in there, which I can test if I say there was no decrease on sales. We'll have the numbers, similar numbers throughout. So it's as good as if I pick that, then I know that it's okay.
Discounted.
So on annual revenue, I'll say from year 1 to year 10, we'll have the 113. Then I'll go to C again. I'll say calculate the annual revenue without any adjustments. So for C, I'll come here and say,
you saw that for PISA, they also repeat this calculation for 80% capacity and use the letter values for P.
Okay, calculate the total output of at 100%. Then repeat this calculation for 80%. Yes. So if you are here, say on B, so the output, basically the output in here, it wasn't the revenue. The output, in short, would be these, the energy levels at 100%, at 80%. So I can come here if I want. I can say answer B. I can do this and do that. Then I can say refer to row number what. So at 80%, we have this. At 100%, we have that output. So that is how I do tackle this. But everything I'm getting it from what has been done.
Yeah.
So that is what I'll do.
Because I also see in his formats, like he doesn't necessarily say answer to A, answer to B, just populates everything in one, and yeah, and then you get those like your internal rates of returns that are also there, but there's no that this is for B, this is for C, this is for D, and not.
So it's supposed to, once you're done with this, because most of it is coming from your model, then you can now start answering specific questions to be safe.
Okay.
Any questions?
If you can just quickly go up. So we have the energy, right, at 80%, and then we have that.
Yeah.
It's that's the energy, right?
Yes, that's
and then we have that, we have that 2,580,000 as well. What is that?
These ones are panels. Remember that the way they were selling
those are the
power,
number of panels.
Yes, you remember that they are generating sales not from energy, they're generating sales from the panels.
Oh, okay. All
Because we
right,
are
then I
given
understand.
here, I don't know if it was an error from his part, but energy revenue is being generated from panels. So say
Not from
unit
the
selling price,
energy.
not
All right.
from the energy.
Okay, understood. Understood. That was my confusion. All right.
Mhm. Mhm. Okay. So ideally, this is how you can deal with these questions on time value, whatever. I'm not seeing any problem as long as you just follow what we have been doing. It's basically getting the concept. When you read a case study, try to break it down so that it becomes easier for you to plug into his model, into his template. Let's check on what's on question 3. Oh, I'm not an economist, but let's give it a try. Mhm. The following article by Wood 2021 refers also available as a download with this examination paper. Scan the article, no need to read it in any detail. The article addresses the issue of economic growth in order to generate sufficient economic growth to repay the national debt. Okay, you are wanting, is the English correct?
Come again, sir?
Is the English correct? You are wanting to check, sounds weird, eh? You want to check the calculations for the magic number as reported in this article. So we have deleted one thing, it doesn't make sense. You have been provided with the following information. The level of national debt at the end of 2020 was 3.950 billion rands. Government's expenditure excluding interest payments for 2020 was 1.750 billion. Government's interest payment for 2020 on debt of 3.66 billion at the end of 2019 was 250 billion. The 2020 gross domestic product was estimated to be 4.9 billion rands. Government's income for 2020 was 1.363 billion, which is 27.7% of GDP. In this group, who is the economist? For me, I'm not an economist, but I believe that where there are numbers, because I understand numbers, where there are numbers, we'll compute. But can someone declare that he's an economist? Rico, there's no economist in this group. Or they don't want to declare.
I'll declare Chiamo as a common economist.
Nothing of the sort, man. That person, if they were found, believe me, Rico, there'll be some serious repercussions. We can't be here.
People, we're all engineers here.
All engineers, yeah.
Okay. When you understand numbers, it doesn't matter. It doesn't matter what profession you're in, whether you're a nurse, you're a doctor, you're a mathematician. As long as you understand numbers, it should be very easy because it just needs to be logical. You know what it is what happens at national level can be filtered at personal level, can be filtered at corporate level. So we just need to understand what do they want us to do? If, for example, the South African government has huge debt, the question would be, how much revenues are they making? How much revenues are going to statutory obligations such as employees and all these other things, salaries? How much is left for debt servicing? Most of these countries, trust me, they have overborrowed to an extent that what they are generating as revenues, they are not even able to pay for their loan repayments. Where they even signed that they'll be paying every year, or in a year they'll be paying twice. They cannot manage because what they are generating is much, much lower. And especially for countries that have borrowed from China and Asian countries. From Europe, it's different. They'll require that you do the modeling, you do debt sculpting, and all these other things. But most African countries, they go to China. That is where they get their financing, for a simple reason that the Chinese do not ask for your ability to pay. But if you make a mistake, they'll get your national assets.
They're capturing.
Hmm?
They're capturing them.
Yeah. So the 2020 gross domestic product was estimated to be 4.920 billion. Government's income revenue for 2020 was 1.36 billion, which is 27.7% of GDP. We have been given assumptions, so we'll deal with these assumptions. National debt can be treated in the same way as a bank loan, but at a lower interest rate. The debt repayment period is 20 years, and each year the repayment amount is recalculated on the same terms, but based on the revised deficit. If the government expenditure exceeds revenue in any particular year, you hear this, if government expenditure exceeds revenue in any particular year, the difference is simply added to the deficit. Government expenditure, excluding the interest payment, will remain stable at 1.750 billion in constant 2020 rands. You must ignore inflation in this question unless requested otherwise. Government revenue will always be 27.7% of GDP. Use the Excel blah, blah, blah. Assume the real, okay, we can do this thing, guys, so let's do it. As long as we understand numbers, there's nothing special in these questions, nothing special at all. Okay. So we'll start with assumptions. As a financial modeler, for me, what is most important is assumptions. Once we know our assumptions, we understand them, then we can model anything. So go up there. So say government revenue. To be 27%. Is it 27% of GDP? Okay. Then GDP growth is 2%. In year zero, at the end of 2020, that you use billion as your currency, enter the value of 250 billion as 250. Okay. So in year zero, which is 2020, so say year 2020, what is there? Okay, we'll look at this first. So national debt of 3.950. $3.950 billion rands. Mhm. That's the best year. 2020 is the best year. Then we are told government's expenditure excluding interest payments. So government expenditure is 1,750. This is it without debt servicing or interest. Mhm. Okay. So government's interest payment for 2020 on the debt of 650 at the end of 2019 was 250. Mhm. Interest payment for the best year was 250 in the best year. Mhm. Then the 2020 gross domestic product was estimated at 4,920. This one 3,950. What is this? Now confused.
There's a dip.
Okay, so the level of national debt at the end of 2020 was 3.9.
Yes.
Then what's the difference with this one? The 2020 gross domestic product. Oh, that is debt. So GDP.
Yes,
sorry.
debt.
Okay. So GDP. What was it? 4,920. This is in the best year. Mhm. Government is income for 2020. Government income in the best year. In the best year is how much? 1,363.
Yeah.
Mhm. Again, here I will say best year. Mhm. What else? I think we've harvested almost all the numbers here. Is there a number that we have left? I think all the numbers have been harvested. Eh? Mhm.
I'm trying to understand that statement, Fitzpatrick. Huh?
On which one?
When they say government interest payment for 2020 on a debt of 3,658 billion at the end of 2019 was. So we have an interest payment of 250. So we're not going to use the 3,658 billion.
It's where?
I'm looking at point number 3.
Okay.
Where we took the interest payment of 250 billion. Point
Okay.
number 3.
Okay, it says government's interest payment for 2020 on a debt of 8 billion at the end of 2019 was 250. So the at the end of 2019.
Yes.
So the 250 was a payment based on the 2019 debt.
2019.
Yes. But then
so
we are
not looking at that one.
No.
Oh, okay.
Because the best year is 2020. But this was actually, we are going to show, to indicate, we are going to include that number in 2020 as a payment on the debt servicing.
Okay. Okay, makes sense.
Okay. So with these numbers that we have harvested, I believe that we can try and deal with missing numbers. So we are starting from 2020. Cost plus 1. So bear in mind that 2020 is just a base year. Then you have to go up to 2040. So let's give it a try. Shouldn't be a problem. So let's start with our GDP. So our GDP, here on top, I'm going to show as billions. Billion rands. So in 2020, the GDP was 4,920. That was the GDP. So the 4,920, we are growing it by 2% year on year. 1 plus, you pick the 2%, you lock. Should remove the. So in terms of the GDP, this is how your GDP is growing. Then we are told that the government revenue, we can come up with government revenue here. So the revenue shall always be 27.7% of GDP. That's what we have been told, isn't it? So we have this number here times 27.7. We are going to lock that number, which gives us this number. We can confirm whether this number is correct. This is the same number that you have here as government, whatever. So it's okay. Okay. What else have we been told? These are the revenues. So from these revenues, we should first check on government expenditure without debt servicing. The 1750, is it also going to continue? What is the assumption? Government expenditure for 2020 was 1750. What are they saying on the assumptions on government expenditure? So government expenditure, excluding the interest payment, will remain stable at 1750, isn't it? So now we'll show expenditure without, I'll do this. I'll just put a small name, no debt servicing. No debt servicing. We'll have this 17 there. Okay, so we need to find expenditure where there's some debt servicing. But again, you can see already that we are going to have a deficit, but we need to check what the definition of deficit is. Is it supposed to include debt servicing when you're doing the computations? Okay. So we are told if government exceeds revenue in any particular year, the difference is simply what we find. Government expenditure excluding the interest payment will remain stable at 1750. Billion in constant 2020 runs, you must ignore blah, blah, blah. Government will always be 27.7. Let me just go up. So the level of national debt at the end of 2020 was 39.50. Government expenditure is excluding interest payments for 2020 was 17.50. Government's interest payment for 2020 on debt, on a debt of 36.58 billion at the end of 2019 was 250. So interest payment, let's bring interest payment here. So the interest payment in 2020 was that, taking expenditure now with the debt service. So in total, we have these two numbers. So we get back. We are told the level of the level of national debt at the end of 2020 was 3950. Government's expenditure, excluding interest payments for 2020, was 1750 billion. That we have already captured. Government's interest payment for 2020 on a debt of 3.658 billion at the end of 2019 was 250 billion. The 2020 gross domestic product was estimated to be 4.920 billion. Government that were factored. Government's income revenue for 2020 was 13.63 billion, which is 27 point whatever. We have factored that.
And like this exam only had 3 questions. What is the GDPs everything?
Yeah.
Okay, I'd lost you guys. My internet misbehaved.
No, that's fine.
Okay. Let's check. Is there a number that we have missed? Okay, so I'm saying using the Excel template provided, answer the following questions. Assume a real GDP growth rate of 2%, calculate the GDP for the next 20 years, setting a 0, the end of 2020. I suggest that you use Arab billion as your currency, enter the value of 250 billion as 250 and not 2 blah blah. Note that throughout this question, real is taken as constant. So this part we have already taken care of it, isn't it?
Right.
Yeah, we have already done the GDP up to 2020.
Yes. Yes.
Then B, for the year 2020, calculate the interest rate which is being charged on government debt. On government debt, 250 billion interest on a debt of 3658. You will use this interest for all interest calculations in your model for government revenue and expenditure. Beautiful. Beautiful. So here we have been given, remember there's this debt, the 2019 debt of 3658. Let me do this. I hope we have. Yes. Sorry. So there's an amount that we do not have. This 2020 3950, what is it?
Yeah, please come on, sir.
3950 in 2019, what is it?
National.
Oh, it's national debt?
Yeah.
Okay, so this is national debt. There's some number that we've been given, then just do this and go back. Sorry. So there's some number that we've been given. It says government's interest payment for 2020 on a debt of 3658 billion at the end of 2019 was 250. So this is what I want, the 3658 billion.
Yeah, that's the one I was thinking.
Yeah, which will be 20 for 2019 was how much? 36?
It is it's 3658
3658 billion.
billion. Yes.
Yeah. So this is debt in 2019, and
Yes.
they are this was the interest payment, isn't it?
Yes.
Mhm. And the period, let me just put the period. Period is for 20 years. Mhm. Okay. So there's somewhere where we've been guided on how we should get the interest. There's somewhere where we've been guided on getting the interest. Mhm. I've been told for the year 2020, calculate the interest rate which is being charged on government debt. 250 billion interest payment on a debt of 658. So we need to find the interest there. So the interest Okay, let me try two methods. I'll try, there's a method called RRI. I hope it works first. RRI, so we have the number of periods is 20. The present value is that. The only problem, I don't have the closing value. So meaning I can use the function called rate. Okay, more ideas are coming. So we have 20. The payments per each period. In 2020, they paid interest of that. The present value, which is 3658. So it gives us an interest of 3 point something, 3.18. I think if I was to try the internal rate, 2020 debt was how much?
2020 debt.
National debt is 3950.
Yes.
Okay, let me just for, let's say 20 from present value. That future value that.
There's a D there.
Oh. Just want to see. It's very low. Okay. I'll leave it at this. So using the rate, looking at the interest payment that was made, the interest payment for 2019, which obviously came in 2020 at 3.1, there's 250, then you have the debt, 658. So we get the interest 3.18%, which then we can now use. Okay, so we have the expenditure without debt. We have the interest payment. This is what we'll need to populate here. You have the expenditure with debt. Okay. So the question now, we should check on the assumptions on debt. So in 2020 as a base, what was debt? How much debt was there? This 3950. Okay, so let's get back to the question. It's more instructive. So I thought for the year 2020, calculate the interest rate, which is being charged on the government debt, 250 billion interest payment on a debt of 658. which we have done. This has already been answered. So I can even highlight it if I want. So I found that 3.18. So this also goes. You use this interest for all interest calculations in your model for government revenue and expenditure. Okay. So we know the debt is 3950 as of 2020. Did they maintain that debt? Because like there's no debt service other than just paying interest, they're not paying any amortization, which is dangerous. Calculate the deficit between revenue and total expenditure, including interest payments. For 2020, and just calculate the total level of government debt at the end of 2020. You have been given this value. So whenever there is a deficit, what is happening on the debt? The debt increases, right? Hello?
Yes, sir.
So come here. Okay. So on the debt, we have this number. So we need now to check from the revenues that we have here, how much is being computed as deficit? I'll come here first. Okay. So the government made a revenue of 1363 or generated 1.363 billion, and they spent 2,000 or 2 billion, meaning that there was a deficit of how much? There was a deficit of 637. So this deficit of 637, it will add to this debt here to be that plus 637 like this. Just take it up to here. Okay. Then we are told this 250 was interest payment based on the 2020 debt, based on 2019 debt. Sorry.
2019.
So meaning that here the interest payment would be this 3950 times 3.18%. And we'll check first on that percentage. I haven't done it correct. I don't think it has been done correct. No. Because this is 250. It should have been slightly higher, I think.
Is it not adding? We're not supposed to be adding from the 250.
No, okay, let's do this. If I say interest, IPMT, I try this. So I'll say the rate, 3.18, I lock it, comma, the period, which is this minus that. That is the period, number of periods, 20. Then the future value, this. Just want to see. Still giving me the same amount. Oh. Because, you know, we got this 200, we have this 250, and when we did the computations on interest, let me do this. You have the number of periods, which is 20 years, minus the payment, which is 250, that's 658. It gives us the interest of this. So if I say I have this number times that same amount, where is it? That's 658. Is it going to give us 50? It's giving us 116. Where is the mistake? Where is the mistake? Where is the mistake? Where is the mistake? I want us to get the interest here, because once we get the interest on, it will be easier now to check on the deficits. Just let me just check with debt up to there. I'll come back there. First, I get the deficits. Okay, let's just get back to the question. Sorry. What is the question? What is the question? Okay. So what are they saying here? The government's interest payment for 2020 on a debt of 658 billion at the end of 2019 was 250 billion. The 2020 gross domestic product was estimated to be 4920 billion. Government's income revenue for 2020 was 1363 billion, which is 27.7% of GDP. National debt can be treated in the same way as a bank loan, that at a lower interest rate. The debt repayment period is 20 years, and each year, national debt, okay, the debt repayment period is 20 years, and each year, the repayment amount is recalculated on the same terms, but based on the revised deficit. If government expenditure exceeds revenue in any particular year, the difference is simply added to the deficit. Government expenditure, excluding the interest payment, will remain at 1750 billion in constant 2020 rands. You must ignore inflation. Government revenue always between 7.7% of GDP. That is okay. Assume a real GDP growth rate of 2%. Calculate the GDP for the next 20 years. Setting year 0 equals the end of 2020. I suggest that you use Arab billion as your currency, i.e. enter the value of 250 billion as 250 and not 250. Okay, that's fine. Note that throughout this question, Rio is taken as constant 2020. Okay. We came here for the year 2020, calculate the interest rate, which is being charged on government debt of 250 billion interest payment. On government, okay, 250 billion interest payment on a debt of 658 billion. You will use this interest rate for all interest calculations in your model for government revenue and expenditure. Calculate the deficit between revenue and total expenditure, including interest payments for 2020, and hence calculate the total level of government debt at the end of 2020. You have been given this value already. Now calculate the real. So in short here, guys, there is no provision for paying principal. Hello?
Yes.
In this question,
Yes, sir.
there's no provision for paying principal.
I wouldn't know, man. I won't lie. This is new. This is very new.
I didn't do this. No, I didn't.
Yeah?
It's in class. You didn't do this.
This is very new.
What?
This is very new, man.
It
Very,
was not part of the syllabus.
yeah.
So
Yeah,
it's
this,
no.
this question is too complex. There's yeah, you even get lost while following.
No, this is very new, Patrick. I won't lie, man. I won't lie.
Okay,
I'm trying to make sense. Yeah, it's very, very new.
Oh, this is when you are even seeing the question. Mhm.
I mean, I doubt if I don't think we covered GDP in our class. I don't think I don't remember us doing that.
Mhm. Okay, so let's follow it here,
Yeah,
because we are
GDP,
saying
TM.
you have PMT, because we want to calculate the interest there. Mhm. So the rate we have this rate. Number of payments, 20 is there. We have the present value of this 3950. Okay. So I'll say minus there. So these are the interest payments. We have the interest rate that we have already computed, which is 3.18 coming in there, because we want to find the principal payment. The PMT, that is a combination of interest and they just made a mistake. It's not supposed to be interest payment going forward. It is debt servicing. So you have the rate, which is that, number of periods, which is 20, the present value, which is at 950. You know, you're making noise out. Yes, you are. Oh. Let's just remove the, shouldn't be a problem. Okay, so we have these numbers here, which then we are going to take up to 2040. So it shows, for example, in 2018, there was an expenditure with government with debt is 2,000. The revenue that was generated by the government of South Africa was on 1.3 billion. So they had the deficit of 637. What this deficit, what it means is that they still went to the market and borrowed. They still went to the market and borrowed. So you have 3,950, you add 637. So this is what you have. And they continued, they were having these deficits. And look at how national debt is growing. You have to sell the whole South Africa and the people inside there. Yeah. Okay. So we have these numbers. This is very interesting. Okay, what else? What other thing? Because we have unlocked it, so we know we have what this GDP is growing. You have your revenue, which is much lower than your total debt servicing. So your expenditure is that. This is basically your debt servicing coming in there. This shouldn't even be called interest payment. This is debt servicing. Okay. So let's go back to the question. So I thought calculate the deficit between revenue and total expenditure. This has been done, guys. Now calculate the real annual interest payment for 2021 based on the level of debt from 2020 using the PMT function in Excel. This we have done. The answers are in the question. You have seen, Rico. Sorry. So we have done, now calculate the real annual interest payment for 2021 based on the level of debt from 2020 using the PMT function, which we have done. And we are saying, in short, this is basically debt servicing. This is debt servicing, not what they are calling it. It wasn't interest. So the combination of interest and that. Then E, repeat the steps C and D for all the 20 years, making sure that you calculate the deficit for each year and the total amount of debt for each year, which we have done. We have calculated the debt, the deficit for each year. This one. It wasn't even a difficult question. Then this has been done. Hence, calculate the total level of government debt and debt to GDP ratio. Again, we did the debt. This is the debt, government debt. So what they want is the GDP to debt ratio. Is it GDP or debt to debt ratio? Debt to GDP. I'll send this for a book. So debt, that divided by the GDP. Okay. What else? Hence, calculate the total level of government debt and the debt to GDP ratio for all the 20 years. Express the ratio as percentage, which we have done. Now use GO6 to calculate the magic number. You must do this exercise by finding the GDP growth rate for which the debt to GDP ratio falls back to 60%. Falls back to 60% of the 20 years. Hint, this ratio is presently 80% and will be 618 at the end of 20 years if there is no growth in the GDP. If there's no growth in the GDP, but we are saying GDP is growing at 2%, right? Is GDP not growing at 2? GDP is growing at 2%, isn't it?
Yes, growing at 2%.
Go back. So I'm saying now use GOSIC to calculate the magic number. You must do this by finding the GDP growth rate. For the debt to GDP ratio falls back to 60% by the end of 20 years. So meaning that we'll need to use the GOSIC. Okay, so that shouldn't be a problem. Okay. Okay, G first. Now use GOSIC to calculate the magic number. You must do this exercise by finding the GDP growth rate for which the GDP to GDP ratio falls back to 60% by the end of the 20 years. This ratio is presently 80% and will be 18% at the end of 20 years if there is no growth in GDP. So what we are doing is that at the end of the 20th year, GDP must go back to, the ratio must go back to 60%, isn't it? So this is what we're going to do. Are you able to see the Excel worksheet? Hello?
No, we are still seeing the question paper.
Oh, sad. Okay. So what they want, these guys, on the debt to GDP, they want this number to go to 60%.
Peter, can you check that number first? If indeed without the GDP growth, it will give us 618%.
Okay, then just go there.
At the end of year 20, yeah.
Okay, it's short term, it's short.
It's short, yeah.
So there must be one part that hasn't been.
Okay, that's fine.
Let's go back. Sorry, let's go back. Okay, first let's just follow it from here. Okay, saying now use GOSIC to calculate the magic number. You must do this exercise by finding the GDP growth rate. First, the debt to GDP ratio falls back to 60% by the end of the 20 years. Hence, this ratio is presently 80% and will be 18% at the end of 20 years if there is no growth. This. Okay, so presently it's at 8. Maybe there's somewhere where we made a mistake. Let's just come here. Mhm. Okay, on this one, we're okay. On the expenditure, pay whatever. Revenue has been maintained. What was the thinking on revenue? What assumption is on revenue? That's why we're having problems. What's the assumption on revenue? Then just go to the PowerPoint. On revenue, what are they saying? Are they maintaining the same revenue?
Saying it's always going to be 27% of the GDP.
Yeah.
Or government revenue will always be 27.7%, or 27.7% of GDP.
Yeah.
Yeah.
Okay. I think there's somewhere where we have gone wrong and do this. Because like we have maintained that number. Yeah. So we have this number. Okay, it's changing, I think. And just check 27.7. It's okay here. Okay. On revenue. Starting at 80%. 20 days. Okay. Then what else? What else? What else? Okay, we are told that on the 20th year, this number here should go to 60%. We'll try and just check what it is. But then what you do is you use your GOSIC. When you're in there, what do we want to pick? So say, you go to data. You go to data, you go to GOSIC. So your examiner wants to see whether you know how to use your GOSIC. So you go to GOSIC, you set the value to 80, which is 0.8. You don't type 80, 0.8, that's 80%. By changing, when you're changing the cell, make sure that the cell that you want to change, there's no formula in it. Otherwise, you refuse. So by changing this growth rate, that's okay.
You're not supposed to change it to 60%, Patrick.
It's supposed to change to what? To 60?
I think it says 60% here.
Oh, okay. So
That's 60.
okay, 60. So you go in there, you say GOSIC. You change it to 0.6 by changing which value? By changing the growth rate. By changing the growth rate. And press OK. Okay. So whatever you're changing, when you do your GOSIC, the best thing is that you can even just highlight this using your favorite color, whichever, whether it's yellow, it's whatever. So then maybe also the other thing is that where you do not have a deficit, I guess it should be able to show a zero number there so that it doesn't reduce on your debt, but it should show your zero number. So you can put in a formula where you can say equals, or let's pick the max between these and that. Then you take it up to there. Mhm. Then you can redo the thing, having it at 18. Then go 6, 0.6. And by changing which cell, by changing the growth rate here. That's okay. Mhm. Unless there's an assumption that we had missed, we can counter check, guys. So maybe also the question would be, with this, the growth rate, or GDP growth rate, okay, it's growing from 2020. Revenue, it's given there to remain as is. Debt servicing will be growing. Then you have the total expenditure with debt. Then you have your deficits in there. Mhm. So this is how it would be computed. Mhm. So I leave it back, I reset it to 2%. Can you check on his original document? If he resets to 0, is it going back to 618? Or it was just an error?
Yeah, it does.
Where are the
What I'm saying,
Hmm?
the difference is on the, I think, the real revenue.
On revenue?
Yeah, the first value it's called. Oh no, I was looking at the wrong place. Fine.
Yeah, just check so that we check where maybe there was one assumption that
Oh,
was
they are
taken.
fine.
I can't get you, Sarah.
Yeah, actually, Sue is right. If you put in if you remove the growth rate, the 2%, the entire revenue,
Oh, it
the
was wrong.
difference in the amount is the same throughout, and then he's getting that 618%.
Okay, so but where are the differences with what we have done? Confirm on GDP. Check on the last number on GDP. What's the last number on GDP in 2040?
No, it seems like you've done something. The last time I checked it, there was a difference when I turned my eyes.
Just get your growth rate. Put your growth rate at 2% first. We start from there.
See, yeah, it's at 2%.
Yeah, so if it's at 2%, what is the GDP 2040 in 2040? Is it 7311?
Yes, 7311.
Then which is this next that we have done there?
Yeah, and then
This one that gives 2025.
Wait. I think then the ratio. Okay, this ratio is 275.
Okay, but first just check on revenue. I want to go stage by stage. On revenue,
Okay.
2040 revenue. Is it 2025?
Yes.
Yes.
Then we go to, this one is given expenditure without debt, 1750. You get 1750.
Yes.
Then on debt servicing, which obviously maybe could be calling it interest payment, whatever. What's the last number on debt servicing?
I don't see that.
We've
But,
got debt payments and debt repayments. Which one should you look for?
There is okay for me, because for us we have just put it debt service just as is, because I think there was no distinction where we are
maybe
getting
just-
12.
Actually, after expenditure without debt payments, that 1,750, we have the expenditure included.
So the expenditure in full, how much are you getting in 2014? Because in here it's 316.
3056.
3056.
Yeah.
Okay, because there I said 16. In 2020 it was 2000. What is the value? So obviously it's just here. What's the value there?
It's the same as 2000.
Then in 2020,
Yes, 2020, 2026,
in 20
21.
the differences they start from where?
It's here is 2020, 2063, there 2064.
Okay, those are just the decimals, isn't it?
Yeah. And then 2007, 21,
07. Mhm.
and then 2152.
Okay, 2151 is just decimals and whatever may change of differences.
Yes.
Whatever. Then you have 21 and
2199.
2196.
2199.
Okay, this is 2196. So it also depends on the decimals, I think, on debt servicing and the like. Because here I'm
Debt
getting
servicing.
2196.
Because I think it's this one, he's getting 449. Getting
Where?
446. It's
Only
the debt repayment.
it's the debt
Yes.
repayment. So basically what it
Yes.
is that there could be decimals or whatever in terms of the differences in the formulas.
Yes.
Mm.
Because it's 449.
Okay, maybe let's just go up on interest. Just go on that interest.
It's 3.18.
Okay, I'll
18,
put the decimals up to somewhere there. Just increase on the decimals.
No, he's at 318 to there.
Yeah. When you increase the decimals,
Yeah, 3.1824.
increase.
When I increase, yes, when I increase,
Yeah,
I should complete.
3.182418.
Yeah.
182418. 182418. So there's a difference there.
And so the difference is coming from here. So on the interest, if you check on the formula, which numbers did he use? Because
So
as
he
we
used-
use the 3658,
He used 20, so it was that rate equation. And then you see 20 years, he used negative C14, which is 270 billion. And then he used 3950.
270.
Yes.
Where did he get the 270?
Debt repayment 2021, he said 270. I think maybe that's where the mistake came from, because the debt repayment is not 270. Let me see.
It's actually 250.
It's 250,
It's
yes.
250. So you use the 270
Oh.
because the 270 is the one that you're getting down here in here, whatever.
Yes.
So I think he made a mistake. He used this. This is supposed to be computed based on that 3 point what?
Yes. I think
So-
that was a mistake.
Yeah. So I'm sure if you change
if
that to 250,
let's change Let's change this to 250. Changing this to 250, we're getting now an interest of
2.3.
2.358. 2.358 215.
And which date is he actually using?
Which one?
The date, because as we are using the date 2019, which is 3658.
Oh, he's using 2021 actually, debt repayment 2021.
What were the instructions? Because I thought you are using the best year for the 2021, you determine that rate, and that's the rate that you use going forward.
He used 2021, yeah.
Because it was saying, just check, for the year 2020, calculate the internal interest rate which is being charged on government debt of 250 billion interest payment on a debt of 3658. You use this interest for all interest calculations in your model for government revenue and expenditure. So I made the mistake.
Oh,
You have seen, eh?
Yeah.
He made an error because we should have used this in getting that 250, use that rate. And this is the same rate that now you're going to apply going forward.
Because in his input, this is all in his input. He has national debt end 2019, which is at 3658, national debt end 2020, 3950, and then debt repayment 2021, which is 207.
Yeah.
I think.
But you see, what it is that in 2021, this is the 270, but this 270 is coming in through your computations.
Yes.
By using that number of 318 on top.
But this one is inputted. You can see its number that is typed. It's not pulling it from anything.
so if you're using this 2019 3658, that's when you get one.
And the idea you have to use 319 because you check these interest payments or interest charges. They are lagging behind because first the year finishes, then you charge interest, and this is the interest that goes into the other year, whether you're paying it or whatever, and assume that it's been paid. So what he did, he got this number 270, hard coded it, and took it up there and changed the formula. Okay. So just an error from his part.
Yeah.
Okay, so that is what was done. You can, and this question is not difficult. You can just do a bit of some practicing. I hope tomorrow it comes.
It's gonna be the end of us.
Hey, my guy.
No.
But
You see, your logic, Fitzpatrick.
Yeah,
I'm saying your logic, it makes sense, like it does, like how you were tackling it. This type of question, there's just too much going on. And even our assignment, I thought the assignment was broad, but when I look at this, our assignment was easy.
But this, you just take it, always assume that it's at domestic level, it is at home. You are getting a salary of, say, for argument's sake, 70,000 rands. And what you're actually paying out there, what you're supposed to pay, your expenses, it goes to about 60, plus those guys that you owe, it goes to 70. So meaning that for you to pay that, you are borrowing again from somewhere, which should start adding on your deficit. So as you are creating that deficit, it's adding on your debt. You should celebrate if this thing comes.
Huh?
Look at the logic. You have seen how this logic is working.
Fitzpatrick, you want to see us again here next year? I see. A lot of these classes with us.
Okay, so this was the final. I wish you all the best. You can just say bye, 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 bye. I'm sure we'll never see each other after this. So,
Hey, this is
but there'll be a
not
day,
much,
maybe there'll be a day,
respect.
maybe there'll be a day that I'll be the president. Then you'll remember me. You remember me.
Yeah, it's a
No,
small world, this one.
but Tiamo or Patrick before he leaves. I think that last question, even if it doesn't compute it, just to I think there was a trick on that question. Here, or it's not here.
Hello?
Solo.
Tiamo.
Hi, yeah, I'm here. You're saying?
I was saying that question of having two options to, I think, decision making, or the one of solar, what was that? The solar or what?
Oh, paper for 2019.
Just that question, yeah, to
Yeah, I don't think Patrick has that question paper.
It does.
Yeah, there was we were actually doing a question paper where it spoke about. Am I able to share? I think I can just access it quickly.
Okay, let me just do this. Let me give you the security.
Let me just log into
You can share.
this. Also, can you access it quickly because I have to log in.
Yeah, okay. It was 2018.
2018.
Yeah. Maybe. Yeah.
Question?
I think it was the first question where it talks about solar geyser and an electrical geyser.
Oh, yes.
Are you on it?
Yeah, I'm there.
It's me, ne?
Okay.
Yes.
We're able to send. Okay, it says you are considering whether to invest in a solar water heater at your house. you already have an electric geyser, but it has recently burst and needs to be replaced. You decide to compare the two options based on the following assumptions. Interest rate 12%, inflation 6%. So the capital cost, which is for the solar water geyser, you have 35,000 rands, electric 3,000. Lifetime of item, 20 years solar water. The other one is 5. Operating costs, 24 for electric geyser, 12,000. This is per year. Maintenance cost, 200. All costs are in South African rands. You must assume in year 1 that the inflation index is 1. So this is where in year 1, if your inflation index is 1, there is 100%. In year 2, it will be equals 1 times open bracket 1 plus your inflation on top, which is the 6%. Then you grow it up to is it 20 years or 5 years if you are looking at the electric geyser.
Okay, because I think that's why the tricky part was. So I guess
Then what you do? So what you do now on the electric geyser, you don't end at 5 years. What it means that when that geyser ends at 5 years, because you add again, you start
you add the money, yeah, you add that money, the initial, because the lifetime is 5 years, so you add on to, yeah.
You add what?
12.5. No, sorry.
At the end of 5.
At the capital.
No,
the
capital, which is
the 6th year. 6th year, isn't it? So it has ended at 5th year, your geyser now is trashed. So 6th year, you bring in a new geyser at 3,000.
3,000, yes.
But don't forget that when you're bringing this geyser at 3,000, you should also increase it by the prevailing inflation, since you had already done the inflation index. You get that, huh?
So on the 6th year, the 3,000 that you're adding, you're also including the
Yes, also
inflation
include
rate.
inflation.
Yes.
Because obvious assumption that the geysers, the price is also increasing on an annual
Inflating.
basis. It's just that you're not buying geysers every year. But if you are buying geysers every year, you find that the price will continue growing.
Buying after 5 years.
Yes, after 5 years. So you accumulate whatever based on your inflation index, you multiply it by that, or you divide, sorry. So it will give you the price. You multiply it to give you the price at that stage. Then again, you introduce these new numbers, the 12,000 and 2,000 every year. Again, go just like that.
Oh, it's a 5-year term.
Yes, it's a 5-year term.
Yes.
So you cannot
It's a
compare
5
a
years.
20 and 5-year term. You want to compare all of them on 20 years.
Oh.
But I think there was a bit of like there was a bit of to have a solution there. There was a bit of mistake here when he was adding through. Do you have a solution open there, Solo? Because you see that, okay, it starts at year 0 and then it says 1, 2, 3, 4, 5. Okay. And then on the 6th year he added, which I feel like, okay, that was making sense. Question 2. There's question 2 there. Yeah. So the 4015 for electric, that is fine. He added on, so it started at year 0 and then said 1, 2, 3, 4, 5. And then on the 6th day he added. And then now this new geyser, I don't know if the first year is taking it on the 6th year or is taking it on the 7th year.
The new geyser?
Yes, the new geyser. So where do you start counting? We start counting at 6.
At 6. Because what you're assuming is that this geyser, you have got it now.
In January.
And, in January. And now it actually takes for 5 years, up to the 1st December, whatever, which is in the 5th year. Then in the 6th year, you introduce that geyser with different costs.
Yes. Okay. Okay, then that's fine.
But then it means he's wrong, because look at his inflation index. Or is he started it at?
Yeah, I think
Yeah,
it's
no,
okay
in year
because
0 it's
in the
okay.
beginning it's 100, yeah. At 0 it's 100, and then year 1 that's it's gonna inflate by that because it went through a year. So year 1, that's year 1 in December. It's already it's gonna inflate.
So let's check on that 3,000.
Already used 50%.
Do this for me. Go into where you have 4,015. Let's see the inflation which was added there. Double click. Just in the 415. Just double click. I want to see.
Oh, okay.
Double click.
Oh.
Okay.
Yeah, it took the previous year.
Connection was interrupted, not
P, only P.
It took the previous year's inflation index.
I think it's okay, isn't it?
It makes sense.
It's buying this
in January. Really, it's
January.
using the previous. It's using the previous year's inflation rate index.
There it's okay.
So I think his ideology here was okay.
I think it was that inflation index that was a bit tricky. Because I thought, it started increasing on age.
Yeah, it started from 0 to 0, it's 100%, and then it started increasing each year by whatever inflation rates that we have.
Okay.
Yours okay on this one.
All right. Okay. Thank you very much.
Thank you. Tomorrow, just be calm. Be calm. You know, these questions of yours, what I've observed is when you go through the case study, just break it down, put your assumption nicely, then you start seeing it more clearer. So be calm. Okay, the last statement, the bye-bye statement.
Don't worry.
Close.
We will definitely put you on speed dial, Patrick, tomorrow.
I must be in the meeting. I'm one of the most busiest persons. Okay. So last statements. We close.
Ash.
Yeah, well, I think we've learned a lot. Even the tricks as well. At least I managed to get 1, 2 where I'll be saving time. Actually, I went through your tricks on YouTube. Yes. And yeah, I thank you very much. You've opened, a lot of doors that I couldn't see what's happening. Yeah. I'll do my best.
Even where there were no doors, you just create one.
Yeah. No, but you couldn't see. It's just a wall. But yeah. Thank you.
I'm humbled. I know this world is too small. One day you may want to come to Zambia for a workshop, for work. Obviously, you'll find us here. South Africa, we normally come there. It's just that after COVID thing, I haven't traveled to South Africa. But next time I'll be that side. At least I have Rico and Selmo. I'll definitely give them a call and we can just meet and relax. Are we outside the numbers? Okay.
Yeah, no, from my end, Fitzpatrick, no, thank you, man. Like, it's been good from day one. There's a lot that has been learned throughout our journey. Yeah, and you're right, it's a small world. Zesco is part of our client, so most probably I'll come through to Zambia and I'll check you out there. Yeah, we really appreciate your time that you've sacrificed to be with your family to give us this. And yeah, may God bless you and continuously bless you for your kindness.
Thank you. Thank you.
Thank you.
Yeah, Patrick, thank you very much, man. Thank you very much. I really just don't know what to say, man. You've been very helpful throughout. Yeah, like Rico said, man. Yeah, from the beginning until today. And hopefully, I mean this. Hopefully, hopefully that I get to meet you sometime whenever you come through the site. It will really be an honor, man, to just chill and then have a call on and just talk about anything else but this. Yeah, most definitely. Yeah, it's been a pleasure to actually meet you virtually, and then hopefully tomorrow, whatever that you've embedded in us, it pays off well. Yeah.
Thank you, Sam. Terence.
Thanks a lot, Patrick. Yeah, I think we have learned a lot for the past 3 days. I can say I'm 80% ready for the exam. Yeah, but you have been helpful for the past 3 days. I really appreciate what you did for us, and hopefully we'll do well tomorrow. Thanks a lot, man. Thanks.
Thank you. Motsweni.
Sorry, I was busy with something. No, man. I'd like to thank you. At least now I can see where I'm lacking, because I don't think I'm ready at all for tomorrow. 50% ready. Yeah, well, I can do a lot of things which we've been doing, but that doesn't guarantee me that I actually understand everything you're doing. Just doing it for the sake of passing this module. So yeah, but thank you, man. I really appreciate it.
Sure, thanks. JM.
Hi, Patrick. No, I share the same sentiments as the rest of the team. We really appreciate your time and effort. Thank you.
Thank you. 0154. Madam President, sir. Madam President. Madam President.
Evening, everyone.
Good evening.
Yeah, Patrick. I came into these lessons with like very little knowledge, but yeah, I might say that going out, I've learned a few things. Yeah, thank you very much, and thank you for your time, and thank you for your precious time and effort. And yeah, God bless you. Continue being great. Hey.
Yes, thank you. Thank you so much. I wish you all the best. I don't see any other possibility of you failing these exams. I'm not seeing anywhere where you would actually fail these exams. I wish you all the best. But as you get into the exam room, please just be calm. You may have challenges 1 on 2. Don't get discouraged. Actually, we have passed exams where we thought we are going to fail. So just be calm. You will face 1 or 2 challenges, but ultimately you will still pass. Thank you so much and have a lovely evening. Tiamo, obviously in the background, we'll discuss. You know what I mean.
Sure,
You know what I
definitely.
mean.
Yeah.
Okay, thank you.
Yeah, most definitely. Most definitely. Most
Yes.
definitely, man. Don't worry.
All right. Thank
Thank
you.
you. Thank you. Bye-bye.
Thank you, Patrick.
Thank you. Thank you so much. Bye.
Good
Bye-bye.
night. Bye.
Good night.